Welcome to Intelligent Investor Insights with Joshua and Robert Barone. They're your co-hosts and guides through the noise of today's markets. Here, we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
All right, let's kick things off by breaking down the real mechanics behind why the US dollar dominates global finance. This isn't some branding coup. It's because the US built a system nobody else has matched, starting with the Treasury market. You're talking more than $600 billion traded every single day, not to mention treasuries being the backbone of global repo markets. That kind of liquidity and collateral utility doesn't exist anywhere else.
Yeah, and it's not just about the sheer size, right? There's an institutional trust factor too. Stable courts, regulatory predictability, and the Fed's independence. Investors know what rules apply. And honestly, there's something to be said for a legal system that doesn't surprise you with a new rule book after every election cycle. That's boring, but for capital, boring is beautiful.
Don't forget, global finance isn't just money moving around, it's security, literally. You have US naval power forcing open the sea lanes, offering stability in Europe and Asia, and underpinning the world's trade and contracts. And of course, there's the infrastructure, SWIFT, CLS, all underpinned or steered by the dollar and the US legal system. The world's running on this operating platform, not just holding a currency.
Yeah, it's like the dollar isn't just a product. It's the system people plug into. You don't switch operating systems overnight, especially not with your life savings or your national reserves on the line. But here's where things get interesting. After Russia's reserves were frozen in 2022, the conversation around the dollar changed overnight for a lot of our clients. I remember getting calls. Can our cash just be seized? Is that really possible? Yes, it is. And that's not some wild conspiracy. It's documented. Ever since, countries and investors have been stress testing their defenses because now it's a matter of counterparty risk, not ideology.
Right, you're seeing record gold purchases by central banks, over 1,100 metric tons last year to be specific. They're not buying gold to speculate. They're buying to diversify away from potential jurisdictional risk. The implementation of non-dollar payment systems is another pragmatic move. No one trusts that their reserves are untouchable anymore, and they're acting accordingly.
Exactly. And you've got things like China's CIPS, regional swap lines, and distributed ledger tech picking up steam all after 2022. They're not ditching the dollar, but they are preparing backup plans. Call it hedging their dependency. If you're in the risk management business, it makes sense.
Let's talk about fiscal discipline, or really the lack thereof. The US has been running up deficits, Treasury issuance is ballooning, and yet foreign demand for treasuries is fading, down to about 30% of official holdings from over 50% at the peak of the financial crisis. Those aren't just numbers, they're a signal.
Right. Watch those auction signals, TED spreads, swap spreads widening, soft indirect bids. It all means the market's quietly demanding a risk premium for holding treasuries, which for years were treated like the world's risk-free asset. Now, risk-free comes with a few asterisks for political dysfunction and debt ceiling stunts.
Let's be clear. The world still wants dollars when things get scary. But that world's safest asset badge, it's not immune to politics anymore. I know I sound repetitive, but these structural signals are telling us the privileges of dollar hegemony aren't free.
Asia isn't just talking about alternatives to the dollar. They're actually building and using them. You've got China's CIPS system and that M-Bridge project where Thailand, Hong Kong, and the UAE are also on board, running real cross-border settlements. Plus, local currency and regional sovereign bond markets are gaining traction. It's not marginal anymore, it's viable.
That's the part a lot of Western investors still miss. If you ignore the changes in the market's plumbing, especially the digital stuff, it's like pretending online banking was just a fad 20 years ago. These alternative rails matter, and eventually, capital will flow through whatever's most efficient, not just what's familiar. The status quo isn't a moat.
It's a technical shift, not an overnight coup. Functionality comes first, adoption later, and then, eventually, reallocation. We're in the messy middle phase, but it's progressing.
Japan's policy normalization is the curveball here. For years, the yen carry trade was a big source of dollar funding worldwide. Now, as the Bank of Japan raises rates, those leveraged dollar positions are unwinding, capital's being repatriated. And that gradual move means there's less structural demand for the dollar offshore than people think.
I think a lot of market watchers dismiss this because the process is so slow, almost invisible. But slow doesn't mean trivial. Bob, you've been louder on this than anyone I know, and I've heard you roast more than a few rate strategists for missing the implications.
Well, it amazes me. Some folks stare at the Fed like they're the only central bank that matters. Meanwhile, the Bank of Japan's moves are fundamentally changing global funding dynamics. If you're still ignoring this, you're missing the pre-verbal iceberg.
Every time there's a rattle, a geopolitical shock, bank stress, you name it, everybody sprints into dollars. DXY surges, treasuries rally. It's reflex, pure and simple, and you get back to that safe harbor effect. But once the emergency's over, things get a little quieter, and then you see gradual reserve diversification, more flow into gold, more use of non-dollar payment rails.
It's like the dollar is the ER, your first stop in an emergency, but not where you want to take up long-term residence. People leave the crisis and then quietly move reserves elsewhere. That's why you see this long drift in the IMF reserve data. Dollar share has been slipping from over 70% to less than 60 over 2 decades, mostly piece by piece.
Right, and this isn't some grand anti-dollar rebellion. It's just sensible risk management, a way to hedge against potential political or regulatory shocks in the future. Quiet moves, but they add up.
Let's get into the weeds. Market plumbing. You've got to watch indirect bids at treasury auctions, gold flows, swap line uptakes, the volumes on alternate payment rails like Mbridge, and even things like FRA-OIS spreads that hint at dollar funding stress. These are slow moving on most days, but the first signs of real change show up here, not in the headlines.
I've learned the hard way. Sometimes you get laughed at for watching these signals, right up until liquidity disappears. Remember that repo market freeze in 2019, Dad? Suddenly, the same people who scoffed at all that market plumbing vocabulary were scrambling. Where's my dollar funding?
Exactly. Banks and investors underestimate the importance of these system metrics until reality bites. By the time the headlines catch on, the game's already changed. Watch the pipes, not just the price screens.
Let's pivot to Argentina. If there's a case study for how and why countries cling to the dollar, even in a crisis, this is it. Argentina's tapped the IMF, gotten renewed U.S. Treasury support, and is going through aggressive structural reforms under Milei. But, big picture, their playbook looks a lot like run back to the dollar and make nice with Washington. Military modernization, defense alignments, all of it underwritten in dollars.
Right, and this does more than just stabilize Argentina's economy for now. It's a whole realignment toward the West and away from China. It's economic, it's strategic, and it's a blueprint for how crisis drives countries deeper into dollar dependency rather than pushing them to alternatives.
I use this as an explainer for clients all the time. Countries in distress don't get repelled. They're tied closer to the dollar, but with strings attached. The dollar is their anchor, but it comes at a steep price, both economically and geopolitically.
Exactly. The US picks up another load, financial, military, political. We guarantee their system stability, but at the cost of our own fiscal and strategic bandwidth. Let's wrap a paradox around this. Every global shock only further entrenched the dollar, making it feel irreplaceable. But every recovery period gives nations more incentive to diversify and build out alternatives. So the more we dominate in the short run, the more we invite slow erosion of that dominance over time.
Right. It's like the system punishes exclusivity after every crisis. No one's threatening outright replacement. There isn't a true challenger. But beneath the surface, the incentives for everyone to hedge and move a little bit away from dollar concentration just keep stacking up. It's global monetary system as a slow motion paradox.
Watching from the outside, you only see the dazzling performance during a crisis. Underneath, it's a slow-moving erosion. Ignore it at your own peril.
So where do we leave off? Dollar-centric systems probably stick around a long time, decades even. You'll still see treasuries as core, still see the dollar in 80% of FX trades. But there's this quiet, persistent dilution. Gold, regional Asian rails, stable coins, regional bonds, these are all lifeboats. Each shock sets another plank in those boats.
The dollar isn't going to disappear, but that exclusivity, that's already gone. The future is more resilient, but way more crowded. No one system dominates everyone or everything. It's not total displacement, but it's unmistakable dilution.
If you're investing for the long term or advising others, you can't just copy paste the last 40 years. The world's getting more complex, and your risk management toolkit needs to evolve. But also, keep your cool, keep watching the pipes, and don't buy every headline that says the dollar is dead.
That's the right note to end on. The path forward isn't obvious, but neither is it catastrophic. The dollar's operating system will persist, but there's more competition across the network. Sounds like something we'll be revisiting again soon, don't you think?
Absolutely. Always more pipes to inspect, more cycles to parse. Thanks, Dad. Always a pleasure getting roasted over risk premiums with you.
It's what I'm here for. Thanks for listening, everyone. Until next episode.
See you next time.
Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional level analysis, and a partner in building durable wealth. Reach out to start the conversation and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.